Here's the story. We've got a news story that's evolved. The strength in the U.S. economy is creating a yield story here. Three things are sort of helping us move along here. Number one, yesterday, that ISM services number, kaboom, the 10-year goes from 3.08 to 3.18. The yield curve steepens. It's mostly about the strength of the U.S. economy. But then the Fed has also been a little less accommodative. Remember, Powell the other day says very accommodative policy is no longer appropriate in the current environment. There's a shot across the bow. Finally, we got these trade fears subsiding a little bit. You put these three things together, you got an interest rate story, a yield story here. The question is, what we don't know is how far will this actually go here? We have seen the yield curve steepening, that difference between the 2 and the 10-year. Today, it's about 31 basis points. If you put up that difference, that's the highest it's been in several months. That's a one-month chart of the spread between the 2 and the 10-year. That was enough to get bank stocks going yesterday, and frankly, that's enough to get bank stocks going today. Carl's right. Banks lead the sectors that are on the upside. They're about the only one. The problem is when rates go up, other things start getting affected. So emerging markets, once again, got hit yesterday. We saw Mexico. We saw South Africa to the downside. There's your EEM, which is sort of your proxy for emerging market, down again today. Other interest rate sensitive groups. Home builders got hit yesterday, again today. Industrials a little bit weak. As the trade war story kind of tops out a little bit here. So in a sense, this has already started, this interest rate story. You just look at what's been going on. This didn't happen on Monday, but it accelerated on on Wednesday. It accelerated on Wednesday. Look what's happened. Home construction stocks, ITB, down 9% in the last month. The REITs are down 5%. Utilities not down as much. My point is that this has been going on for a little bit of while and is now starting to accelerate. This is not just the only place this has happened. U.S. 10-year yields, we told you yesterday, at the highest since 2011. But we're starting to see this around the world here. Japan's 10-year is the highest since December 2016. The German and the French and the Spanish 10-year, they're already starting to creep up as well. They're the highest since May, and they look like, you look at the chart of these things, they look like they definitely want to go higher. So this is, to a certain extent, a global phenomenon here. And remember something, when this is old chestnut, when risk-free assets start repricing, that means something, and it moves throughout the U.S. economy. So here's what you want to watch today. You want to watch bond ETFs. We had enormous volume yesterday in some of the big bond ETFs. The IEF is the 7 to 10-year ETF for 7 to 10-year treasuries. The TLT is 20 plus, 20 to 30 years. We had volume there we have not seen, some of the highest on record, among the top 10 ever. What that tells you is a lot of people are just coming in and at some point selling treasuries, and one point late in the day they actually reversed it and turned around and started buying treasuries. But this is the kind of stuff you want to watch now to figure out what kind of appetite there is for whether yields are going to go higher. Can't answer that question right now, but suddenly those bond ETFs are real important. 77 points of the decline on the Dow. Carl, back to you.